It was supposed to be an ordinary Thursday morning. Two people left for work within minutes of each other. They lived in the same city. They drove similar cars. And just a few weeks earlier, both had renewed their auto insurance. One of them chose the cheaper policy. It saved about $13 a month. It didn't feel risky. It felt responsible. After all, why spend more on something you hope you'll never use? Then, on the way to work, everything changed. Both drivers were involved in nearly identical accidents. Their cars suffered similar damage. The repair estimates came back surprisingly close. But when the claims were processed, their financial futures went in completely different directions. One driver paid a small deductible and moved on. The other opened a letter that left them responsible for thousands of dollars they never expected to pay. The difference wasn't the accident, it wasn't the insurance company, and it wasn't bad luck. It was a decision that seemed too small to matter until it mattered more than anything else. Most people compare insurance by looking at one number, the monthly payment. According to consumer organizations and insurance experts, that simple habit can become one of the most expensive financial mistakes a person ever makes. Here's why. Nobody enjoys spending money. If you can buy something for less, it usually feels like a win. That's how we're wired. Behavioral researchers have found that when people face complicated financial decisions, they often simplify them by comparing prices first. And honestly, that works surprisingly well for most purchases. If two televisions have the same picture quality, buying the cheaper one makes sense. If two coffee machines brew the same coffee, saving money is probably the smarter decision. Insurance feels like it should work the same way, but it doesn't, because insurance is one of the few things you'll never truly evaluate on the day you buy it. You'll evaluate it on the day something goes wrong, and those are two very different moments. That's why so many people believe they made a smart decision until they actually need to file a claim. Imagine you're shopping for auto insurance online. You receive two quotes. The first costs $68 per month. The second costs $54. At first glance, they seem almost identical. Both mention liability coverage. Both mention collision. Both promise protection if you're involved in an accident. So naturally, the cheaper option looks like the better deal. After all, saving $14 every month adds up to more than $160 every year. Not bad. But here's the catch. Insurance isn't just a price, it's a contract. And two contracts that look almost identical can produce completely different results when you actually need them. Some policies have higher deductibles, some have lower coverage limits, others leave out protections that many drivers assume are automatically included. Those differences rarely stand out while you're comparing monthly prices. They usually reveal themselves after an accident, and by then, it's too late to change your mind. Think about it this way. Imagine buying the cheapest parachute available. From the outside, it might look almost identical to every other parachute. You wouldn't notice the difference while standing on the ground. You'd notice it after you jumped. Insurance works in a surprisingly similar way. The biggest differences aren't always visible while you're shopping. They're revealed when the policy is finally put to the test. One of the biggest misconceptions about insurance is believing you're paying someone to fix your car. You're not. What you're actually buying is financial protection under a legal contract. That contract defines exactly what is covered, what isn't covered, how much the insurance company may pay, how much you're expected to pay, and under which circumstances those payments apply. According to the National Association of Insurance Commissioners, understanding these details is one of the most important parts of choosing an insurance policy. Yet surveys consistently show that many consumers focus almost entirely on the monthly premium. It's easy to understand why. Insurance documents aren't exactly exciting. They're filled with unfamiliar terms, legal language, and dozens of pages most people never want to read. But skipping those details can completely change the outcome of a future claim. So let's go back to our two drivers, because this is where their stories begin to separate. Both drivers safely walked away from the accident. Thankfully, nobody was seriously injured, but both cars suffered significant damage. Repair estimates came back at roughly $22,000. The first driver contacted their insurance company, After paying the deductible, most of the repair costs were covered according to the policy. The process wasn't enjoyable, but financially, it was manageable. The second driver expected the exact same experience. Instead, they discovered several surprises. Their deductible was much higher than they remembered. Their policy limit wasn't nearly as generous as they assumed, and one optional coverage they thought was automatically included wasn't included at all. Within a few days, what had once looked like a smart decision to save $14 every month had turned into thousands of dollars in unexpected expenses. Now here's the important part. This doesn't mean cheaper insurance is always bad. In many situations, a lower-cost policy may be exactly the right choice. The real mistake wasn't choosing the cheaper policy. The real mistake was assuming cheaper automatically meant equivalent. And that's a mistake far more people make than most realize. So what actually separated these two drivers? Surprisingly, it wasn't one dramatic mistake. It was several small decisions that didn't seem important while shopping for insurance, because every insurance policy is made up of different pieces, and every one of those pieces affects how much financial protection you actually have. One of the biggest examples is something almost every driver has heard of: the deductible. A deductible is simply the amount you agree to pay yourself before your insurance begins covering eligible repair costs. Let's say your car needs $5,000 in repairs. If your deductible is $500, you'll generally pay the first $500 while your insurance covers the remaining eligible costs. But if your deductible is $2,000, your share becomes much larger before your insurance contributes anything. That's one reason cheaper insurance can sometimes have a lower monthly premium. You're taking on more of the financial risk yourself, and that's not automatically a bad thing. If you have enough savings to comfortably cover a larger deductible, it may even be a smart financial decision. But if an unexpected $2,000 expense would create serious financial hardship, saving a few dollars every month may not be worth that trade-off. The important point isn't that one deductible is always better than another. It's understanding what you're agreeing to before you need to use your policy. There's another phrase that causes more confusion than almost any other: full coverage. It sounds reassuring, almost as if it means everything is covered. But according to consumer insurance organizations, that's not actually what the term means. In reality, full coverage isn't a standardized insurance product. It's simply a common way people describe a policy that usually combines liability and comprehensive coverage. Even then, every policy can still have different deductibles, different limits, different exclusions, and different optional protections. That's why two policies, both described as full coverage, can still leave drivers with very different claim results. The name sounds the same. The protection may not be, and that's why insurance experts often recommend comparing the actual coverages instead of relying on labels alone. Many people believe insurance companies deny claims simply because they don't want to pay. While disputes certainly happen, the reality is often much less dramatic. Many denied or partially denied claims happen because the policy never covered that specific situation in the first place. Sometimes the damage exceeds the policy limits. Sometimes a particular type of loss isn't included. Sometimes required documentation is missing. And sometimes people simply misunderstand what their policy actually covers. That's one reason organizations like the National Association of Insurance Commissioners encourage consumers to review their policies before an accident happens, not after. Think of it like buying a concert ticket. If your ticket includes general admission, you can't expect backstage access just because you assumed it was included. The ticket still works exactly as promised. It just doesn't provide benefits that were never part of the agreement. Insurance works much the same way. A policy can perform exactly as written while still feeling disappointing if expectations didn't match reality. By now, you might be wondering, if the cheapest option isn't automatically the smartest, how should someone actually compare insurance policies? Financial educators often recommend starting with a handful of simple questions. First, what are the liability limits? Second, what deductible are you comfortable paying if something happens tomorrow? Third, what situations are specifically excluded from coverage? Fourth, are important protections included automatically, or do they cost extra? And finally, if you had to file a claim this afternoon, would you clearly understand what happens next? Notice something interesting. None of those questions begin with price. That's because the monthly premium only tells you what you'll pay today. The coverage determines what you might have to pay later, and that's the number that often matters most. Let's go back to the two drivers we met at the beginning. Same city, similar cars, nearly identical accidents, yet completely different financial outcomes. Not because one person was unlucky, not because one insurance company was dishonest, and not because one driver forgot to make a payment. The biggest difference was understanding what they were actually buying. Insurance is one of the few financial products you hope you'll never have to use. Ironically, that's exactly why it's so easy to underestimate. Unlike a phone, a laptop, or almost anything else you buy, you don't discover its real value the day you purchase it. You discover it on one of the worst days of your year. That's why many consumer advocates encourage people to compare coverage before comparing price. Not because the most expensive policy is always the best, and certainly not because the cheapest policy is always the worst, but because the right policy is the one that matches your financial situation, your risks, and the amount of financial responsibility you're realistically prepared to handle if something unexpected happens. Saving a few dollars every month can absolutely be the right decision, but only if you fully understand what you're giving up in return. Sometimes the cheapest insurance really is the best choice. Sometimes it isn't. The goal isn't to buy the most expensive policy. It's to make an informed decision. Because when it comes to insurance, the price you pay every month is only part of the story. The real question is what happens on the day you finally need it. If you found this video helpful and want clear, research-based explanations of insurance and personal finance, consider subscribing to Coverage Clarified. Every week, we break down complex financial topics into practical, easy-to-understand guides designed to help you make smarter financial decisions before they become expensive mistakes. Thanks for watching, and we'll see you in the next video.